Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.
Tonight, Apple hits $3 trillion in value, becoming the first U.S. company to do so. December's non-farm payrolls came in less than expected, adding only 199,000 new jobs for last month. And Toyota has dethroned GM as the #1 automaker in the country in 2021, marking the first time on record that a foreign car manufacturer has topped the list. We'll have that and more tonight on Wall Street Wrap-Up. Hi, welcome to Wall Street Wrap-Up. I'm Andre Laborde. For this Friday, January the 7th, 2022. Well, the first week of January is now over. It's in the can, and hope it went well for your liking. December's job numbers came out today, and they were disappointing. Hiring for December slowed during the heavy Christmas season, adding only 199,000 jobs that analysts were expecting to be closer to 422,000. The numbers were less than half of what the analysts had wanted, and what's moving the markets this week are a number of different factors. Because this year, in 2022, the withdrawal of stimulus into the economy by the Federal Reserve and inflation are big concerns. And a jobs report today for December was expecting to produce more jobs than actually did, and that surprised the markets. And the Omicron virus is not far behind it. It's slowing the recovery, but not derailing it. Well, coming up in the show, we'll be talking with the CEO and chairman of Gabelli Asset Management and Gameco Mutual Funds, Mario Gabelli. Mario was named Money Manager of the Year by Institutional Investor for 2011 and Morningstar's Portfolio Manager of the Year in 1997. Since its inception, his funds have returned 16.3% annually. Mario Gabelli will be with us in just a minute. But first, well, all three indexes ended lower for the week. It was the Nasdaq's worst week since February of 2021, with the tech sector having the largest losses. This week, the Dow Jones Industrial Average ended up at 36,338, down 4 points for the day and down 0.3 of a point for the week. The S&P 500, they closed at 4,677, down 19 points for the day and down 1.8% for the week. And finally, the Nasdaq, they finished the week at 14,935, down almost 145 points for the day and down 4% for the week. Citigroup has issued a statement to all of their employees: no jab, no job. All Citigroup employees will be able to keep their jobs, but they have to be vaccinated. And Bank of America analyst Justin Post, he's raised Meta Platforms, which is formerly Facebook, to a strong buy with a new price target for Facebook at $410 a share. Well, Mario Gabelli, he's one of the most respected investors on Wall Street. Barron's Magazine includes him annually on their Barron's Roundtable of Professional Investors, and he's here with us tonight. Let's get to it. Hi, Mario. Welcome to Wall Street Wrap-Up.
Privileged to be here again and talk to you about the world that we live in the investment world, particularly in the equity markets.
Thank you, my friend, and I'm so happy to have you here. Mario, as we're going into 2022 now, how does 2022 look for you when it comes to the stock market?
Well, you basically have had a very good tailwind of the market. I think the economy is going to be reasonably bright in 2022. The example I like to give is I go back to January, February of 2000. January, February 2000, okay? Mm-hmm. The economy was moving along at a 70 mile per hour in terms of real terms. In real terms is defined as productivity and population growth. The economists would talk 2.5%. Inflation was running, 1.5%. Now, in March or April of 2020, it dropped down to 20 miles an hour. And all of a sudden, companies cut back, Andre, in terms of CapEx. They cut back and did everything to improve liquidity. They stopped ordering stuff. They laid off people. But, we've underinvested. We made mistakes of not encouraging investment in certain critical areas. Supply is not going to come on quickly. Demand is going to go up. But more importantly than that, wages are going to go up. You cannot give a teammate an increase in wage and then ask them to cut it back. It doesn't work that way. And when I go and fill up my gas tank and I go out and buy stuff at Costco, which is where I shop, or a food store, I come home and I say, hey, listen, I got the bitching principle. It's a principle that deals with the notion that, hey, things are going up and my wages aren't going up. So I'm going to go and ask my boss for more wages. And that's going to create a inflation dynamic. So the stock market will also, profits will be quite strong because companies are learning how to live with this. Their cash flows will improve. Tax rates are the same. But we have one minor item, and that is the Fed. And the Fed is going to withdraw the punch bowl.
Do you think the market is already tying in that 1 or 2 rate increases in 2022 in the stock market, or do you think it's going to be a hit for us and the market is going to drop when they finally do it?
Well, let's give you some math, okay? We basically have debt at the moment for the fiscal year ending September 30th, 2021. Let's call it 28 trillion. We're talking about running a deficit for the fiscal year ending September 30th of another trillion or so dollars before we try to put in social infrastructure into the program. From my point of view, the Fed has to cut back on putting money in the system, but more importantly, they got to find a way to take back some of the $8 trillion they on their own balance sheet of IOU without having a multiplier effect on their monetary supply. And I don't think that's going to be easy. I think that's going to result not, they may try to set the rate up twice, but I think the market's going to act differently when they start seeing inflation increases, particularly from the wage sector coming in. Then we have to ask about what is called on Wall Street the black swan dynamic, an unexpected event. We're not even talking about geopolitical. I'm dealing with what is likely to occur at the Federal Reserve and have a higher probability of being correct than I am of talking about what's going on in Iran, Israel, North Korea, and the rest of the world, and what's going on between Russia and Ukraine, and what's going on between China and Taiwan. And then all of the things we don't know about, but that's okay. We deal with those a wall of worry forever, Andre. But how do I protect my capital? How do I protect against the rapid increase in inflation? And how do I preserve wealth over an extended period of time? And those are the questions that if you want to own a piece of America and the entrepreneurial system we're part of, that's the questions you're asking.
Are stocks such as, and I'm thinking of bank stocks or REITs, or what type of sectors is it good for an investor to be getting in with interest rates going from a 0 to 25 basis points up to maybe?
Yeah, I got it. Look, I have a summa cum laude and gray hair. You see this?
Okay.
And the reason is that I was an investor doing sell-side research in the 60s. That is, I would cover companies and take my research as part of a focused intensity on industries in which we had core competence. And all you did was you looked at managements and you asked questions. What happens if interest rates go up? Is that going towards underlying inflation? So if inflation is running at 3 or 4% on a secular basis, what's the 10-year bond going to do? Is it going to 5%? Well, I got my first mortgage, Andrea. I bought a house for $30,000. I came up with $2,000. I had to borrow X. I actually took a second mortgage out, but my interest rate was 6%. In 1979, I bought a 10-year govie.
Oh, wow, 79? That was the highest, yeah. Yeah.
No, 14. I know you agree with that. Shows our age. 14 and 7/8 coupon.
No,
today, 10-year govie today is probably 1.50.
Yeah.
So when I'm discounting back the present value of that future stream of earnings, then the question is, what companies have pricing power that can, and where is the demand for their product that is that inelastic, so it doesn't have an impact and there's not a lot of substitution. So when you have a utility, their rate of return on investment is locked in at 10%. So much has to be capital, so that if interest rates go up sharply, it is very lag effect with regards to how they can get a higher rate of return. Secondly, then you look at companies like supermarkets. If I'm selling a basket of goods and I have constant volume, a constant mix, and prices are up 3%, and my gross margin, I'm giving a discount, but my SG&A is not going to rise as much, and therefore I can have enormous impact on my margins. And so those are the kinds of questions we have to ask. And the good news on a secular basis is that owning American businesses that have good managements, and there are many of them, that have this pricing power, but also have good accounting. You know, you got to have LIFO as opposed to FIFO, blah, blah, blah. And bottom line, those are the things that I like. Now, growth companies that are selling at 35 times revenues, you know, there may be a chilling effect. On the other side of the coin, I always find that good companies with good managements, with good cash flow, will do well.
Well, first off, I thought that gray hair that you had was from your grade school pictures exactly. You haven't changed a bit since you were 12 years old.
No. Andre, listen, I've been in the market since 1955, okay? When I bought my first stocks, I was 13 or 14 years old. But I was 7 foot tall and had red hair. And the markets have beat me up since then.
I gotcha. When it comes to supermarkets, you were mentioning, I mean, the largest food distributor, from what I understand, is Walmart. I mean, they've got more volume than than the Krogers or the other grocery stores that are publicly traded. Would something like a Walmart be good because of, like what you were just saying, with they sell groceries, they're increasing their margins for that, and they're increasing their
as much as we like Walmart, so we like Sam Walt and everything that he did and all the creativity, we don't follow Walmart.
Retail stocks in the fourth quarter of in the third quarter of 2021 and in the fourth quarter of 2021, retail stocks are really high. I mean, we just talked about Walmart, or you're talking about Costco, Kohl's, Dillard's.
Yeah, you're talking about things that I don't focus on. Our core competency is anything you drink anywhere in the world, we follow. For example, Remy Martin and how they're going to do in China. Companies that sell Truly and White Claw, that is beer, and wine and booze, Jack Daniels. You drink it, we follow it. Think about what is going to do well. Right now, at the end of 2021, you're going to have probably 1.2 million cars on dealer shelves. That's new cars. We were going to sell about 14 million. At the end of 2022, we're going to try to sell 16 or 17 million, which means you get a strong ramp up in production, and the demand is there. And then production will have to rebuild at least 1 million to 2 million cars on the dealer shelves. So what works in that area in 2022 and 2023? And then the question is, how do you buy these cyclicals, Andre? And having started covering the auto industry in the 60s, it's very simple. How bad is bad? And it's bad. How long will it be bad? Then how good is good? And then when looking at specific companies, what gives the multiple to the stock a good kick up in terms of the market valuation when earnings are starting to reflect the rising and surge to 18 months from now? The second area is aerospace. Look at Boeing's challenges with the 737. They have cut back. They've got X number in the parking lot somewhere that they need to kind of tweak a little bit and get them out. And then they're going to ramp up production. And the number of new airplanes that are needed in the next 20 years are significant. And so what is the ecosystem of Boeing as they start ramping up? Then there's the housing market. And we learned that there's a shortage. You cannot have the price go up so high without increasing demand and supply, then in addition to that, you have a new dynamic. If you and I were here 80 years ago in the 1930s, we'd talk about rural America and we'd need to put in plain old telephone service. Today, we want broadband, remote learning, remote work, remote medicine, and which companies benefit from that. So that's my landscape for 2022 and 2023.
Mario, what about when you just talked about auto parts and automobiles? And I know that when I followed you for years, and also even the last time, we've talked about things like genuine auto parts, and I know you've followed O'Reilly. But today, they've even in this new tax bill, they're talking about they're putting money in for EVs, electric vehicles. Will companies like General Auto Parts or O'Reilly or things, will they benefit as the years go from 3 years from now to 4 years from now, going from fossil fuel type of automobile-driven cars to more battery-driven vehicles? What are your thoughts?
Andre, you have, as always, you have a perception. So let's step back and look at the world. Right now, we have approximately 1.3 billion cars in the world. Mm-hmm. We produced in 2021, we'll come in with about 70, call it 75 to 80 million. I don't have the precise number. Let's call it 78 million. I believe that by the year 2030, we will be producing close to 110 million cars. Of that amount, 30 million will be EVs. In the United States, we have 278 million vehicles on the road. This year, we will sell 13 million. And by 2030, maybe 30% will be EVs. So the cumulative effect of electric vehicles is there. Secondly, the mechanics in the United States have to be retrained, retooled to understand more electronics and be able to do that fix quickly. In addition to that, remember that a lot of companies like Tesla do not have franchise dealerships. Where are the repairs going to be done? The weight of the car is high. As a result of that, you're going to have to, your tires are going to wear out, your suspension systems are going to wear out, but the electronics are going to wear out and have more challenges. The industry itself is tracking that data. It clearly will be less spend per vehicle. I don't know how you handle the notion that right now I pay a gasoline tax that fuels infrastructure, that is highway rebuilding. How do we put in a use tax? How do we go in and then find the companies that are going to take the charging point at my house, much like I have a standby generator like you do. And if you don't get one, who repairs them?
Yeah.
And how do I live in an apartment building in an inner city and have a charging port? And secondly, I'm not making a lot of money, and the car's like a Tesla selling me $60,000. And I need a used car. What am I going to do? I need to keep the used cars. There's 35 million, 40 million used cars sold this year. So it's not as simple as saying, EVs will substitute. Clearly, oil is one element. Lubricants for certain parts will continue to be there. Clearly, you don't have spark plugs. These are fairly analyzable things. Then the question is, well, how's the stock market? How will the stock market pay you? And then you get examples of a car. Some guy pushes a truck down a highway and he gets a $40 billion market cap. Mm-hmm. So you're going to see a lot of this hype. We saw this with Enron. We saw this with WorldCom. And you always have some challenges. Not that I'm saying any of these were.
Mario, I don't know if you're like me, but I'm sure there's other people like me. I can't tell you how many times I've gone to bed and forgotten to charge my iPhone in, and I woke up in the morning with a dead battery. Well, it's one thing when you don't have an iPhone that's charged in the morning, ready to go to work. But when you need to get to work, wherever it may be, and you forgot to charge your car in, like you do your cell phone, you're in trouble. And so I'm sure.
No, but we'll solve. Look, technology will solve that problem. We'll solve that problem down the road.
They're going to do that for me.
At the moment, the conclusion is don't sleep.
That's it. It's the only way to do it. You're right. We're going to take a break right now. If you're just joining us, we're so happy to have him back. Always a friend of the show, Mario Gabelli. Don't go away. We'll be right back after this. Mario, our gaming stocks, and I'm thinking, because we talked before about, last time you and I were together, I think we talked about Penn National, but, companies like Penn National or DraftKings. DraftKings has been taking it on the chin lately, and I think Penn National too. Are these stocks, like these gaming stocks, now good times to buy?
One of the better managed companies is a company out of Reno, Nevada called Caesars. Okay, the team there are doing extremely well. The stock in March of 2020 dropped to like $6 from 50. It's now, last time I looked, 15 times that price. And I think they have done a very good job of putting a footprint in. The number of states that are permitting gambling online is ongoing. Then we have the companies that have the FanDuel and the DraftKings brands. We have BetMGM as part of that. And that and during the process that you see, every time there's a cycle, there will be significant winners and significant losers. And then stocks get hyped up and they come down. I like the companies with good management, good brands, good access to customers. So what is the subscriber acquisition cost if you're doing direct TV? Take Live Nation. They have your name on every contest. Every time you go to a concert, you're buying a ticket through Ticketmaster. They have that data. They can use that data. But they can't give you the rewards and the accessibility that some of the landline land companies do. Do I want to buy Steve Wynn's company? Not his anymore. And they have operations in Las Vegas, and they have in Boston, Macau, and so on. Mm-hmm. They also have a big Macau. Mm-hmm. So I don't know. Carlino did a good job at Penn, but I don't cover that one as carefully as I used to, and I can't comment on some of the others.
I understand. Got it. In fact, just as a point of reference, Mario, you were talking about Caesars. In the New Orleans area, we have the New Orleans Superdome. Well, we don't call it the New Orleans Superdome anymore. It's now the Caesars Superdome. So they're making
smart guys.
That's right. They sure are. Mario, I got time for one more.
Hey, by the way, the next thing they'll do is take Commander's Palace and call it Caesar's Palace.
Well, if they do, I promise you a dinner anytime you want when you come down to the Caesar's Palace over at Commander's.
I will circle that firm. Last time I was there, unfortunately, it was a while back, was when I addressed some of the trustees at Tulane.
We'll make it a definite. Got time for one more question, Mario. What's the best investment advice were you ever given?
I actually, let me tell you what I give. The best investment advice, obviously, was a professor I had at Columbia Business School by the name of Roger Murray, who succeeded Professor the Graham and Dodd and taught value investing. And figure out, what is a business worth? How good are the people? What price are you paying for it? And so then you read the contemporary. Spend $1. You can't spend $1 anywhere, but go online and get the Berkshire Hathaway annual report and start reading on some of the sayings of Warren Buffett, and look at how they value businesses, and look at patience, and look at the notion of how to protect capital, how to increase capital, put money away over the next 20 or 30 years to save and have options in your retirement, and just be patient and look at compounding. If I was able to buy the island of Manhattan for $24 in 1624, even with the problems of New York today, under the previous administration, under XYZ, de Blasio, it's worth about $3 trillion. That's only a 7% compounded annual growth rate for 400 years.
That's it.
So stay around, be patient, and hopefully we allow ourselves to give some of our intelligence and our financial flexibility to the next generation and the next generation, and then have all generations, the next gen, particularly the new participants in the American system, sharing the growth, sharing the opportunities. And I think it's a great system. It worked for me, and it's going to work for a lot of people in the next 20 or 30 years.
Mario, let's not this be the last. I'd love for you to come back, my friend. Thank you so much.
Well, considering that the wine list that Commanders is interesting and you're willing to buy, you may see me sooner than you think.
Absolutely. Okay, you got a deal. Thank you so much.
All right, take
You're
care.
on. Thanks a lot, Mario. Appreciate it. Well, So how should the stock market do for the remaining month of January? Now, on average, the month of January normally has a 1.2% return for the first month of the year. Now, that's on average, and that is when the S&P 500 ends the previous year below 20%. Now, on average, when the market ends for the previous year above 20%, well, usually that January is either flat or it's down. Well, the S&P 500 ended 2021 at 26%, above 20%, so it doesn't look good for January, but we'll see. Well, if you've got a question about finance or a comment about the show, we'd love to hear from you. Make it pithy, make it concise, and write us at Andre@WallStreetWrapUp.info. And now for a look ahead for next week. But first, what comic strip first appeared on this day in 1929 that later became movies and a television series? We'll have the answer in just a minute. What comic strip first appeared on this day in 1929 that later became movies and a television show? Tarzan. And by the way, you would also be correct if you answered Buck Rogers. That comic strip started also on the same day today, January the 7th, 1929. Well, as we start the new year, many brokerage analysts are picking their best picks for 2022. Morgan Stanley has picked their best to be Adobe and FedEx. Cowen and Company thinks Amazon stock will be rising to $4,500 a share. And JP Morgan is picking Apple and Qualcomm, while Wells Fargo likes the electric truck maker Rivian as their pick at $118 a share for this year. And finally, if you thought you may have had a bad week, well, technology stocks took a hit this week, and many of the tech billionaires, well, they lost big time. Sergey Brin and Larry Page, the founders of Google, lost $5 billion apiece. And Mark Zuckerberg, the founder and CEO of Facebook, now called Meta, lost $4.5 billion. Steve Ballmer, the former CEO of Microsoft, his net worth dropped $4 billion, as well as Bill Gates. Well, he dropped $2 billion as well. And by the way, that's not counting what he's going to pay in the divorce settlement. And finally, Larry Ellison, who founded Oracle, he lost $3 billion this week as well. Well, you know, when you think about it, it's only on paper, right? $1 billion here and $1 billion there, and pretty soon you're talking some real money. Well, coming up on Wall Street Wrap-Up in a couple of weeks, are you thinking about maybe buying a car? If the answer is yes, you'll want to watch in 2 weeks from now when our guest will be the head of automotive for Consumer Reports, Mike Quincy. Now, Mike always is a lot of fun of do's and don'ts on car buying. We'll tell you what homework you'll need to have to be prepared to make the best deal with that car salesman, and what is it about those extended warranties. We'll be talking with Consumer Reports automotive specialist Mike Quincy. Now, when we interviewed Mario Gabelli, we started talking, and there was just so much information he was telling us, we decided to make 2 interviews. So next week, we'll have the second part of the Mario Gabelli, where he talks about where there are opportunities to invest in the media, in gaming, and other stocks. That's next week, our second part and conclusion of Mario Gabelli on Wall Street Wrap-Up. And as a reminder, we repeat the show on Sunday mornings, but always the best way is to set your DVR so you'll never miss an episode. And that's our show for Friday, January the 7th, 2022. Hope you've enjoyed it. My thanks to Mario Gabelli for joining us this evening, but as always, we appreciate you for allowing us into your homes tonight. Remember, follow us on all the social media, on Facebook, on Twitter, YouTube, and WYES.org. So enjoy your weekend ahead and have a productive week as well. I'll see you next week for Wall Street Wrap-Up. I'm Andre Laborde. And remember, money never sleeps. Good night.
Sponsored by New Orleans Distillers, creators of fine spirits and liqueurs. Through dedication to science, art, and passion, blends of tradition and flavor emerge. For you, always locally crafted. New Orleans Distillers, classically Southern.